What's up, world? What's up, Razzak? How you doing, man?
Hey, Mike, doing great.
Good. Well, very excited for today's episode of Blood, Sweat, and Balance Sheets. Before we kick things off, could you go ahead and introduce yourself for those who aren't aware? A little bit of background, be very much appreciated.
Absolutely. Razzak Jallow, CFO FloQast's, been here 2.5 years. This is my second Blood, Sweat, and Balance Sheets episode, so really happy that you're having me back on. And before that, I've been tech finance for my whole career, whether that was starting off with Adobe and helping to switch from perpetual to subscription software, some time at Apple, Lending Club and FinTech, and found really, the B2B SaaS at Looker and then Google. So, but definitely found my home here at FloQast, and it's been a wild and fun 2.5 years.
Yeah. I think the first time was more of kind of a career conversation and promotion path and all that good stuff, which you've clearly executed on very well. But today's for a more special, unique announcement that we have. This doesn't happen every single year, fortunately, but we're very excited to be announcing our Series E round of fundraising, mostly as led by yourself. So I think that's why we wanted to have you on. This process was incredibly different than the way that I've done it in the past, which has been, me, myself, and I going out and trying to make all this stuff happen. So for today, we're hoping to just kind of go through the process a little bit, illuminate the audience on how things work behind the scenes, delve a little bit into maybe, how we plan on using the money and all that kind of stuff. But really want to focus on, what's the process like and how did it go and all that good stuff. So before we start, I do want to give a plug here to one of our favorite new things that we have, which is FloAcademy. It's our learning portal online. So this podcast will be available for CPE credits. So if you care about remaining an active CPA, feel free to hop onto our service at FloAcademy. You can find it on FloQast.com and get there, and you'll be able to watch this podcast and get free CPE credits for it. So I have a massive library there of content that if I do say so myself, is much better than the other content that's available on the market. So please feel free to check that out. And the price is right, being free.
Free is good, and the content's really engaging. I really like it. So.
Yeah, it's good stuff. Objectively, I do love it, and I wish if I had to remain active, I would take it. But fortunately, I don't. I'm an inactive CPA, and so here we are. All right, well, let's kick it off with, I guess, I'd love to understand. Let's see, heading up to your time at FloQast, you were a VP of Finance at Looker before you joined, so you weren't the CFO in a fundraising capacity. But ahead of this, what type of experience did you have in the fundraising world, and kind of how exposed had you been?
Yeah, actually pretty minimal. I think I'd been exposed primarily through the FP&A lens. So building a lot of the long-range models, building plans, especially on the road to IPO, of how do you have a beat and raise model? How do you align on what are the metrics that you want to create and you're willing to speak to every single quarter? So mostly around those pieces to it, not so much the relationships with investors and how you evolve those over time. So a lot of that was new to me.
Okay, that's really interesting. And for those listening, some of these conversations are Razzak and I are having for the first time, like this one. So you're getting, I'm learning in real time as well. So, okay, I was actually really struck with how good of a job you did maintaining the relationships and some of the strategy and the people strategy around the process and everything. So did you have mentors from the past that you were tapping into to get advice on that front? Were you or our board members? Like how'd you go about learning how to do that? Because I'm pretty surprised actually when you say that you were mostly on the modeling side before, because I thought you did a killer job on the relationship and sort of strategy side.
Yeah, definitely. Board members were extremely helpful. Existing board members, different CFOs in my network were helpful. It was also helpful hearing the variety of ways companies do it. Like some of the CFOs I talked to said very structured, very owning the process from beginning to end, very mathematical and analytical in it. And others were much more hands-off. Like, well, nope, the CEO led all of it. I wasn't really involved that much aside from providing the financials. And so there's a wide gamut there. And it was nice hearing all those different stories. I could pick the one that I felt would work best for FloQast.
So in those conversations, did companies of different stages approach it differently? Like was there, and I'm leading into where we're going with this conversation later, but the CEO doing it versus CFO, is that stage specific or is just?
Yeah, I that's absolutely a theme through it, especially earlier stage. It's more, they probably don't even have a CFO, definitely more founder-led. A lot of the investors are more not just betting. The amount of their belief in the founder is actually a big part of the valuation. Like even if this isn't the right business or whatever, like this guy's going to figure it out or this girl's going to figure it out.
Yeah.
And so the later stage, you're attracting more investors that are either late stage crossover or even full public equities investors that are looking for more, consistency and building that consistency over time. So if you tell me a number and I tell my LPs this is what the number is going to be, or I tell my investors this is what the number is going to be, I want to make sure you're coming back and saying to me, hey, I'm still talking to the same numbers and I keep beating them. So it's just a very different type of investor between Series A and B and Series D plus. And so that certainly resonated in some of the people I benchmarked against. Their Series B and C experiences just weren't applicable to the round we raised.
So it seems like if I had to paint a general trend, maybe as you get larger, arm waving by the CEO matters less, because it's more a bet on the business and not the founder or the CEO as you get bigger, it seems like.
Yeah, I think that's fair. I think there's just less room for wild pivots. It's like, well, you've already got product market fit and you've already got some scale going. Like it's not, there's just more solid data to get your teeth into as an investor.
Right, I guess. Okay, because I'm in our FloQast bubble where we've been, pretty much since the seed round, like executing, here's what we're going to do. And there hasn't been a big pivot in what we're doing. So I guess if you're a serial Series A investor, you're used to seeing some companies just completely rip up their operating model and go in some different direction. So the founder's ability to figure stuff out really matters more. Yeah,
absolutely. And they've relied on the founder, and the founder's built an entire team, like hired 400, 500, 600 people. And so there's just a lot more consistency there.
Okay. Yeah. All right. Well, let's take a step back and talk about this actual process and really go into like how long it was. Because I feel like it kicked off all the way back at that like JMP conference that we did when you first started. And it was that, 40 meetings back to back. Let's give the accountants on the line some perspective into what these conferences are and how they go. Because I was not aware of this world. So you want to just I'm curious from your perspective, what do you think about these things?
They're very good for one of two things, right? Either you want to get your name out there and meet a whole bunch of people that you don't have connections with, or it's another time for people you already have connections with for you all to be in the same place and you can meet face to face. So our first ones were very open.
Let me set the stage a little bit more. Okay. So there are a bunch of investors. JMP is one of my favorites. I've known Pat Walravens, the analyst over there, since the beginning of FloQast. So they're investment banks. They help lead IPOs or participate in IPOs, and they'll set up these conferences where they invite every late stage crossover public investor that they know to attend these things. They line up a bunch of portfolio companies. They go and speak. I've been speaking at JMP for way too long. Like we were way too early the first time I spoke at JMP. But as we get bigger, we've drawn more interest from the investors because they are later stage investors by default. And then also I've been able to shed some of my time and don't give that presentation. Now you hop on stage and give that presentation about FloQast at the investor conference. So that's the meetup that we're kind of establishing. And so with that, all right, I'll hand it back over to you.
Yeah. So that's a great context. And so when you go there, you normally have a presentation, and then the rest of the 2 days you just have back-to-back meetings with investors over and over again. And it's a little formulaic in that you end up repeating yourself many, many times in back-to-back meetings, which can be exhausting, to say the least. You would think just sitting in a conference room wouldn't be exhausting, but somehow just meeting 7 people for half an hour and telling them your story over and over again is quite exhausting.
Well, let's keep it really real with everybody. It's not a conference room. You're in a hotel room. You're like, they clear the beds, they bring in a big table, and you might be at a round table with 6 investors from 3 different firms around the table, and it's and they're 20-minute slots, and you're back to back, and what is it? You have 7 hours worth of meetings, so that's 21 slots. Maybe you got 2 or 3 investors. So you're talking to 50 to 60 different investors, and you can't. I don't know. How were you able to keep track of any of those people? Like, what's your takeaway from those meetings?
So there's many different types of investors, right? Some people are sending kind of their new analyst on more of like a data gathering mission. They're like, let's figure out what this company is. Let's figure out what's the industry space. Let's learn as much as we can there. And then there's other ones that are the primary investor who will make the call on whether they want to actually build a relationship with FloQast. And so that's why I liked it when you were talking and I could be taking notes. That made it a lot easier to keep track of everybody.
That's fair.
When you weren't there and I couldn't do that as easily, it was harder to keep track of people. But I mean, we had what do we have a list of like 125 investors that expressed significant interest in FloQast over the years. So it was, it's a good way to get to know a lot of people, but eventually you got to narrow the pool down.
Yeah. And my big takeaway, and this is maybe a little bit of foreshadowing, is the ones I remember were the ones who were actually already familiar with FloQast and had really good in the weeds questions. And in the spirit of foreshadowing, Roy from Iconic was incredible. He knew everything about our business already and just had the most in-depth questions. Meanwhile, the other people at the table were like, "What do you guys do?" Like, just it's so you get kind of annoyed having to do that pitch over and over again when all this information is publicly available, or you could have attended our speaking session and have seen this and go from there. So yeah, for any investors, I guess, who might be listening to this, if there's any, just be prepared and know about the business. And that's like one of the best ways to stand out, which feels like a pretty low bar. But yeah, Roy did a killer job at it. And World Innovation Lab was another one. They popped in and knew all about us, and we're really excited about it.
Well, it's easy to sit here and give tips, but I want to give another tip too. Like, if you're a company and you've sent 2 different people to the prior 2 conferences to talk to me, read their notes before we meet the third time.
Mm-hmm. Yep. So okay. So it's an exhausting day, but you make a bunch of connections, you get a bunch of investors build up, and then it's about whittling it down. And I basically ejected myself from the investor relations process from there and really handed it off to you. So tell me about what the next couple of years looked like leading up to this.
I think a good lead into it is actually even before that. Like for me, it was really understanding, coming in new to the company, understanding your long-term vision of where the company's going and what we needed to do to get there. And then with that in mind, having all these conversations about, okay, who's the right investor that's going to see this vision and what do they want to see out of a company on this path? Mm-hmm. And so that really helped me. Obviously, we talked a lot about that when I first joined. So it was
I had to recruit you over here. Yeah.
It was easy to then take that understanding and knowledge and say, okay, now we can approach this next phase of finding the right partner very intelligently and very thoughtfully. And so over those next 2 years, it was getting our name out there and understanding all the investors out there, like we talked about, and seeing which ones were going to be the perfect partner for us on that journey. And as you mentioned, Roy stood out really early in that process. His understanding of what we were trying to do and why we were trying to do it, and on board with that Forever Elevate accounting piece that's been core to us, really stood out. And so even though we weren't raising at that time, finding the right people early. And then I mentioned my background is more on the metrics and FP&A side. So understanding which milestones we want to hit as a company to prove that we are going to be that platform of the Office of the Controller was really important for me. And while this is going on, it's also about the execution along that path internally. So it all comes together a little bit in that way. But the next 2 years, we're meeting with many of these investors multiple times to really suss out, like, could they be a great partner for us? Are we just a value player? Or do they believe in the full vision of what we can achieve? And you'll see, every investor loves you and thinks you're the greatest thing in the world. Because they want to keep all doors open. So you've got to figure out which ones are just saying that and which ones like truly believe in the vision.
Mm-hmm. That's a really good point and a tough distinction, I think, to make. Because why, if you're a VC, you're going to say all the right things because you want to have an opportunity to look at the deal and kick the tires and see if you can get there on price. But at the end of the day, being nice up front doesn't mean you're going to get there on price and put a term sheet on the table. So that's how you avoid wasted time and distractions, right? Is not spending time with people who are never going to disqualify up front. You
still had to spend a lot of time with people, but would have been 10 times more if we hadn't gotten the list more manageable.
Yeah, totally. So, so the other thing I want to note is, at these meetings, they're asking you, what's your plan for the year, all this kind of stuff. And I mean, we're not saying exactly our plan is to add X million. We're not exact about it, but we're at least give some direction in what we want to do and where we're heading. And so if they're good, they'll take their notes. And then they'll meet us the next year and be like, hey, did you do that? And then they'll review their notes and be like, yes or no, we didn't do that. And so, I think execution is really important because when you're building the relationships and you're telling people what you're going to do, you have to actually do it afterwards to get that confidence. And if you are able to execute and make it happen, particularly through a bear market, right? Because it's been a tough market since we started having those conversations. And so the ability to execute through that, I think, is a really important proof point for investors. And if I were one of them, I'd feel a whole lot more comfortable investing in a company that's doing what they say they're going to do.
Absolutely. And you've got to be a little transparent to get some interest. Like I think the biggest complaint, or one of the reasons we get a lot of positive feedback when we go to these conferences, is that we've been very open and transparent, at least directionally on how we're going. I think, if you're going to go to these conferences and you're going to get up there and say, we're not disclosing even what revenue band we're in, we're not telling you at all what growth rate we are, or any metrics for them to even just place you on the company scale, it's really hard for them to know what to ask or how to engage, right?
Yeah.
So if you go in there and you won't tell them if you're 5 million or 150 million in revenue, you're going to have a hard time having conversations with the investors and analysts there.
And maybe it's just a me thing, but if there's not transparency, I assume the worst. And so, if someone's not comfortable talking about growth rate or NRR or something, it's kind of like, it's probably because you want something to hide. When they genuinely might just like to be confidential about stuff. It might just be their preference, but not where my head would immediately turn.
Yeah, and as a CFO, you're always a little worried because you want anything you say to be perfectly right. And the fact is that when you're earlier stage, some of your ARR or NRR data might not be perfect. So it's fine to kind of give directional piece, but you got to let them know, are you a 150% net retention or a negative 10% net retention? You got to give them some direction there, even if you don't give exact numbers.
Directional accuracy, yes, makes perfect sense. So, okay, let's talk about the touch points with the larger group of investors, the ones that I wasn't necessarily exposed to. So how much... Give me a sense of, for the stuff I wasn't involved in, roughly how large was the set of investors that you were kind of keeping in touch with? How did you do that? What were those conversations like? Just tell me more.
Yeah, I guess so. We had a list of 124, I think, that we had met with and had expressed interest. Said, hey, we want to be in your next round. And of those 124, they were pretty. They weren't just. They were pretty forceful. Like, hey, we definitely want to be in your next round. So that's still too big of a list, right? And so I would say I probably kept in pretty good touch, at least every quarter or so, with maybe about 40 or 50 of them, and then really close touch with maybe 5 or 10 of them. And so that's the going a little bit deeper with them, explaining a little bit more. These are the ones that felt like could be a really good fit. But I do think also really early on, we knew Roy and Iconic was the right one, so he's probably in a separate tier than the other 5. So that's a lot of time suck. It's a lot of time suck to have those meetings every quarter, and you've also got the bankers wanting to have meetings with you every quarter to check in. So managing your own time and quickly figuring out which ones just isn't going to be a fit is really important just for your own sanity.
And this is why investor relations is a thing. It's a full-time role at a lot of companies. Not just, I always interpreted investor relations as with the current investors. I had never, in my role as an accountant, I hadn't processed like, oh yeah, you have hundreds or thousands of other investors that you're maintaining the relationship with. And so that's how this quickly balloons into a full-time job that you happen to just take on as part of your, while you have your day job of being the CFO of FloQast.
Yeah, absolutely. Right. I think, our private company investors obviously report to their broader teams every quarter on how we're doing. But if you think of, public equities analysts, like they're actually putting their full models out there, with each earnings call. And, they've got to have a long trust on like, okay, you said this is how to model your business. Don't change that on me because I'm going to advise everybody I know on whether you're buy or sell based on that and based on whether you hit these underlying non-GAAP metrics or not. And so there's an even more scrutiny as we progress along.
So let's talk about timing of maybe running the more formal process. You approached me, I want to say late Q3 or early Q4, like, hey, I think it's time to kind of do the final leg of the process, I guess. So can you tell me about why you thought that was the right time and then how we move forward from there?
Yeah, absolutely. I mean, it was really just, in our executive strategy sessions, it seemed like we had a great handle on everything that we were planning to do in our current product portfolio and geo expansion. And then we were seeing just great signs from our customers that they wanted us to do more, that we had the capability to solve more of their problems. And it was time to kind of put the foot on the gas on some of those ideas that we had. And so I think, given that we had proven that, hey, with our current, for me, I'm a little conservative as a CFO. I always want to make sure we have a path to like break even with what we've got in the bank. And so we had that, but it was a nice path. And I think there were just sitting around the table and hearing about the amazing opportunity that we originally talked about 2.5 years ago, and how it was time to start really investing in some of those broader solutions and geographies. It was the right time to raise.
Mm-hmm. Yeah, and for me, I do a lot on gut, I think, as you've probably learned. And yeah,
It's worked well for you.
And my gut was feeling really good about the go-to-market engine. And like we had a big opportunity on the product side. And then particularly with our value prop of having a lot of the data and being able to support downstream processes, it was just like, man, this is really landing on the compliance side, and can we do more of it and build out a bigger platform? And so it felt like the appropriate time to be able to spend more money investing in product overall. So for any customers listening, I guess that's the really exciting part of this fundraise is we're bringing in $100 million to not triple the size of our sales organization. It's to add way more to engineering to build out more products and build a bigger platform. So I think customers in particular should be very excited about the fundraise here. All right, so we agreed it was time to go for the process. We whittled the list down to, I want to say, like 10. And what do you think was what were you looking for with those 8 to 10? If I can't remember the exact number.
Yeah, it was. We got a lot of like blue chip, really great investors in the room to look at it. I think the biggest piece was, are they going to be a right fit? Is back. Okay, you say you believe in a long-term vision. How much do you really believe in it? And so that was where it was really important for me to see them get time with you directly and hear about the vision and see what they, it's a two-way street, right? They're evaluating us as a company, but we're also evaluating them. Like, are they the right investor to help us along to get there? Yeah. And so obviously that matches way better if they believe in the vision at least half as much as we do, or it'd be nice if it's as much as we do. It probably no one out there does it quite as much as we do, but as close as possible. And so that's kind of the big step there. I think we've done a good job of taking out the ones who kind of just wanted to take a look. Every investor has a profile, right? So some like to do majority stakes and don't do a lot of minority stakes. Yeah. Others, are always looking for that underappreciated company that's a value play that can be really cash flow positive for their portfolio. And others just want to invest in a company to get a pop between now and IPO and then get out. And so finding the right one that saw our 5-7 year vision was important. I think we got a good list of those, and then figuring out the ones that were the best fit for that going forward.
Yeah, I think that was maybe the trickiest part of this round is we're with investors at a stage where it very much could be what's the value play, or how are you going to get to break even, or how are we going to clean this up and become cash flow positive ahead of everything. But we want to keep investing in product, and that doesn't align with a lot of the later stage mentality. So how do you toe that line? And I thought you did a really good job whittling that list down to people who fit the bill. And so what happened was Razzak and team set me up with lunches with all these investors. I got to go meet with them. I was really happy with the list and thought they checked all the boxes. My goal in those meetings was to obviously get to know them, see if I just like these people on a personal level and there's someone I could work with. But also, I really challenge them on, we're not here to get to cash flow positive. We will burn money. We're investing in product. Get ready for it, all this kind of stuff. So I was really trying to almost get them to know if they weren't on board with this vision. And fortunately, I think nobody backed off of it. And that was probably because of the qualification work that you did up front to not put me in front of people who would back off of that type of approach.
Yeah, and to your point earlier about late stages being different than earlier stage where it's a little bit more founder-led, I think late stage is also different because founders already proven they've gotten to series. Most companies don't make it to series D and even earlier than that. So It's less about can this founder do it. That's more like the Series A and seed and maybe B conversations, and a lot more about what's the great opportunity here that this already great company that we think can go execute on. So
yeah. Cool. All right. Well, so we had the lunches. I think everyone passed the lunches as well. And then we started to kick off the formal process. And I think your next move of disqualification was sending the expected valuation to people to at least get to a no quickly if we can. And for those listening, if you're going to fundraise or you're going to sell, getting to know is actually very important. Just be blunt about things. If you can hear a no from the prospect or from the investor, then you're not wasting your time on anything anymore. So put, anything that's going to be a challenge for them to get to, just like be blunt and upfront about it. That's why with me talking about the product vision and burning cash, I was aggressively trying to filter people out and get to a no with that. And then with the valuation as well, like for the value investors, they can't expect like a price lower than the last round or something like that. You know what I mean? So I thought, we're obviously not going to say the number, but I thought you did a really good job at least putting out the floor on this. And I think we had a couple firms bow out based on the price that you put in front of them, which shout out to those funds. Thank you for not burning our time, because they very much could have still gone through the process, gotten all our data, done the evaluation, and been like, nope, we're not getting there on price. And so, I don't know. Yeah, for those funds, if they're listening, I really appreciate you saving us time and being upfront about it.
Absolutely. Like a lot of mutual respect there in terms of like, okay, great. Like, you're worth working with in the future, and if something else comes along where it makes sense.
Yeah.
The flip side of that is, one investor like took our numbers, our plan without the raise, added in all the costs of the raise, but didn't give any incremental revenue for any new products, and then cut all our numbers by 20%, on the top line, saying most people probably missed their plans. Said, well, I couldn't get to your valuations. Like, okay, if you're just gonna like double my expense and cut my revenue in half, like you shouldn't buy the company. Like, it's like, what'd you think you were gonna get to?
Yeah, if that's your approach, like I totally agree.
I why did we go through this?
I wouldn't have gotten it. We'll talk afterwards about who that was. I'm really curious to hear that one.
So I guess there's everybody loves you till you talk price, right?
Yeah. So next step, Razzak disqualified on price as well. I think that whittled out a couple. And then the next stage there was I got on a plane, came up to Sand Hill Road, and did the whole VC thing, which I haven't done since, 2018, or 2019. And then, the Series D was obviously remote. And I mean, there was one in-person meeting with George. We had a dinner where we got to terms and got there on price and everything, and we're good. But this was fun to like get back out on the road and actually go meet people and get to pitch in person. It's just such a different energy with all of it. So that was the point at which I got to get involved, do more of the arm waving, do the full Series E pitch, make sure that they understood the platform vision and where we're going, and we're on board with it. And I think my job at that point was just try to get people excited and see how that shook out. Yeah. So that was fun. My job with this thing was like I didn't have to do any of that legwork, and then I just got to come in for the show and tell portion of the presentation.
Yeah, absolutely. And for a lot of people that haven't been in board meetings and things like that, like that relationship's really important between the board member and the CEO, because there's going to be times where things don't go perfectly, and you want to have a relationship with that board member where they can still understand the long-term vision and won't ask for drastic change just because one quarter wasn't as you expected.
Yeah.
And so I still think those in-person meetings are really valuable, and building that relationship and figuring out who do I want sitting in those board meetings every quarter for the next several years. So,
very much so. I mean, it becomes a big part of your life. We were just talking about one of our board members who's been with us for 8 years at this point. And yeah, you got 8 years times 4. That's 32 board meetings that you're going to have where you're talking about stuff. And fortunately, he was on board with the vision up front. And so, yeah, it's never like, what are we doing here? We got to change this. It's more incremental. How can we improve this area? Or should we look at maybe, is this another product line? Is this another country we should expand into? So things like that. Okay, we have all of our meetings. I eject myself once again, and then I think you start fielding term sheets from there. So I'm curious how it's going behind the scenes.
It was going really well. I mean, I think we got most of what we were expecting. So we kind of had the right group of people in the room. We got a little bit of price discovery, which we wanted, but also we're able to end up with the kind of our first choice from over a year before. So it was a really great process, and then shout out to Roy putting up with us going through a little bit of a process with him, even though we kind of knew that was where we wanted to end up. But I think that was good and healthy for us.
Well, no, it was nice. I think you can't sell yourself short. You want to go see what your company's worth. I think that's a very fair thing to do in a free market here. And also, we got to suss out all the investors through that process as well and see what it was like. And I mean, fortunately, from my perspective, we landed the top ones that we were really looking for. We obviously love Roy and Iconic, and they've been great to work with, and I'm excited to have an even deeper partnership with them and work more going forward. But World Innovation Lab, another participant in the round, they're really excited. I can't wait to work with them. They were more in the, hey, we'd love to participate. Let us know when the term sheets come in, and we'll get there on price, and whoever leads it. So they're more of a let someone else set the price, and then they'll try to participate in the round because they help with very specific things. And then MSD Capital as well. And I thought MSD, so they're Michael Dell's family office. They aligned with us so well with he's a founder, obviously, an entrepreneur, big fund, a lot of money, but that long-term vision, and really, really bought into the platform and going bigger with it. And so that they felt like the perfect fit to me when we were going through all these conversations. And so, between what World Innovation Lab can do for us, how aligned we are with MSD and how helpful they're going to be, and then just how much we know Roy and Iconic and have loved working with them, it was like, what a group to pull together. And I'm so thrilled that we got those three funds involved. I mean, there are other great ones. I wish everyone could have gotten there on price or whatever, but these were three of our top choices, and I'm really excited to be working with them.
Yeah, absolutely. I mean, I think there was still a lot more demand to participate in at the current price we got, but you've got to, for people out there, you've got to make sure that the investors you're bringing in, you're giving them a big enough check investment so that it's meaningful for them.
Yeah.
Right. So they're going to invest time in us. They're going to help us. They're not going to do that for a very small check size where it just doesn't make sense for them.
Yeah, and it's interesting because we only raised $100 million. Right. It's weird to say that, but I mean, our last round was 110 actually, and this one was 100. And so with the stage that we're at, these are tiny checks for these funds. And so kind of maneuvering, how do we get everyone enough to where they care about it and give us time was a really important factor of it. And another thing going on the side, I mean, I don't want to go into too many details, but I think it's an interesting thing, is we had an early investor looking to sell some of their position. And so you can kind of take that position and then allow the firms to get enough of an ownership stake to where they care enough about what they have going on, and then fill out the primary round and give them enough. So that was kind of a nice, while in some ways that's an annoying dynamic to have going on the side, all of that going on at the same time, it allowed us to construct the round the way we wanted and get the right people excited about it.
And I think that's an interesting thing for people out there that haven't gone through this before, is that every investor has a different LP base or different funding source, and so they all have.
Yeah, can you just address the LP concept, how that works? Like, VCs have bosses as well. Can you tell
exactly.
us about how that works?
Where do the VCs get their money from? They get their money from investors. Sometimes it's other funds and other VCs. Sometimes it's wealthy, high net worth individuals. Whatever it is, they have some investor base that they answer to. And so that can be very different, right? So if it could be one fund or one high net worth individual that has different liquidity needs than, say, an evergreen fund that puts money in, and is some sovereign wealth fund that's just got an unlimited caching and can be ultra long on everything. And so understanding...
And this is really important for who to partner with, right? You want to understand what probably exactly where you were going, but yeah.
No, exactly. So you've got to understand where, what liquidity needs your investors are going to need over the long term, right? Are they going to have to distribute cash back in 3 years? You might in 3 years have to find some secondary buyer, and that can be very painful if you're not in the middle of a round. Or it can be very painful even in the middle of a round if there's a different price between, say, earlier stage shares or common shares than the latest preferred round. So I think understanding your VC's investor base and when they're going to have to get cash outs really important. It's very common for really early stage to not stay all the way through to the end. But if you're adding new investors at a late stage, you got to make sure that they're not, in my preference, they're not looking for a 3-year flip here or something like that.
Yeah. I think that's the nice thing about our stage now, is it's a lot of buy and hold through IPO and have a position in a public company. And so it seems like that's been a good move. But you look at some of the early investors, if you got in at a $3 million valuation and all of a sudden you're sitting on a gain at 1.6 $6 billion valuation, it's, yeah, maybe I should take some of that off the table and I can go look at other investments. And if you're an earlier stage investor, then having that capital to deploy within an evergreen fund makes a ton of sense to me.
Yeah, absolutely. And if you're, just to hammer on the point you already made, like if you've already 100x your investment, risking it all to go to 300x isn't that big a deal. But if you just made your investment, like you're still bullish on like, oh, we absolutely should be double to triple 4x, whatever they modeled in their valuation. And so it's a different dynamic you're also bringing to the house when you add on new investors.
Yeah, very, very good point. Yeah, different people in at different prices then have different incentives as well. So yeah, the whole let it ride mentality versus that's really good point. And I just wanted to define a little vernacular for those not familiar with it. So when you're fundraising, there's primary capital and then there's secondary transactions. Primary is where you take money and it hits your balance sheet and actually goes to the bank account. Secondary is a secondary transaction off to the side, which is where one investor is buying from another investor. So there's no money going into the actual company. There's no dilution to the company. It's just facilitating a transaction on the side. Oftentimes, I'm going to note this, you will see press releases where, and I know this damn well from behind the scenes, the amount that's announced as the fundraise is actually the combination of the primary and the secondary, which to me feels slightly misleading, right? Because when I think what you're saying when you put out a press release is you should be saying, we raise this much money to invest in the business and go forward from there. The secondary is not going into the business and helping you drive forward from there. So I view that as a little misleading. We've never done a press release that included any of the secondary numbers in it, nor will this one. But that's a concept that not everyone just fully understands. So wanted to define that one quickly.
Yeah, and the operational impact of an investor wanting to sell is quite a big burden on the company. So if you think about it, let's say one of these investors we just brought on board was going to sell in 2 or 3 years. The amount of pain it would go through for us to now, well, they obviously want the best price for that shares. Mm-hmm. And so they're going to want the company to go and share all the information with a prospective buyer and get time because the buyer wants to have a relationship with the exec team and know what they're buying. And so it can be a really big burden. That's why a lot of a lot of the investors pride themselves on not putting companies through that. Mm-hmm. And you'll even see some companies say, no, you only invested 2 years ago. I'm not helping you with this at all.
Yeah, yeah, we're very different. We're very helpful with all of it. But yeah, it's definitely like admin work that kind of came out of nowhere, and you're still trying to run a business, and you have to deal with this stuff. But as I've learned over the last few years, such is life, and it's what you gotta do. And I mean, from our perspective, we're motivated to make sure it's the right partner that's buying in, because whether we want the transaction to occur or not, it is going to occur, and we might as well make sure it happens with people that we think are going to be good partners and we're going to enjoy working with, which I think we landed on.
Yeah, absolutely. And the flip side of that for me is like the investor that's been really good to you for a lot of years, you help them out, right? It's more just that investor that came in 5 minutes ago. If they want a secondary, I think founders and CFOs should not feel compelled to help that out.
Yeah. So, okay, I want to take a step back. So that was our process. Very, very formal, lengthy, like incredibly well run. Got our term sheets, constructed everything, and got it done. And then you and Eric, our general counsel, and everyone on the teams got that thing closed so fast. So the wires all hit the bank like faster than any round I've ever that I ever closed. So great job on that front. But now I want to juxtapose this round against how I had raised money in the past and maybe go through that. So I'm gonna briefly summarize them. The first round we ever did was getting into Amplify. That was $50,000, and that was I had a PowerPoint presentation and an idea, and they told me you need a co-founder, a product, and a customer, and then we'll let you in the program. So I went off. I had my marching orders, did those 3 things, and then sure enough, they cut us a check and let us in the program. The seed round was then me just getting no's all the time, man. I was at the end. I was at the bottom of the barrel with investors trying to get, and Amplify did an incredible job of connecting me with angel investors, seed stage investors, like everybody. And we went through their list, and I'm going to chalk it up to a combination of 2 things. One, we're a boring company that does accounting stuff. And in Los Angeles, you have a wealth of opportunity with cool companies that are doing cooler things. So I think a lot of people were just kind of disinterested in the idea and all that kind of stuff. Second, I'm an accountant. It's my first time ever doing this. There probably wasn't a ton of belief in my ability to like figure this out as an entrepreneur, because I don't think the stereotype of an accountant is that you're very entrepreneurial and you're going to be able to figure it out, right? And so I think I was fighting against that a little bit, and clearly I wasn't able to overcome it at the time until we met Toba, and they really liked us. They just seemed to be a really good partner fit. They believed in the product, the idea, and then in us as founders as well. So that one was just me like hearing no so many freaking times, and ultimately getting in front of the right people that saw the vision and would partner with us. And so they cut us a check. That was awesome. The Series A was more of the same. Holy crap, that was so hard, man. That went on forever. I was on a plane all the time up to the Bay Area just to hear no. I remember one story where I was flying up to get a term sheet for the A round, and the SaaS market is just crashing like that day. I don't even remember what happened, but it was like some bad news came out and the market's crashing, and the guy pulls the term sheet. So I'm like, I get up there and he pulls the term sheet, and I'm having this meeting where it's like, well, if you could finagle the numbers and show me that you're going to do this in Q1, then I could get my investors on my investment committee on board with that and excited. And I literally said, I can't just magically update a spreadsheet and like give you a made up number, because what's going to happen is we're not going to do that, and then you're going to get pissed in our first quarter, and that's not a good way to kick it off. So I mean, I would love to work together, but I can't just make this stuff up.
Can I jump in there for a second? Because this is another great thing that I think people don't realize is that when you're raising a round, who the partner is in that firm and how much pull they have is extremely important.
Yes.
Some partners don't have the pull to give a term sheet and stick through it and push it through IC, even if there's like a bad quarter or one thing they don't like, and some do. And so finding that partner that has that, one, understands their IC, so they're not going to take something to them that doesn't pass, and two, if there's 50-50 on it, they have enough pull to push it through, is really important. Mm-hmm. So go ahead.
And that's, the decision-making process is also an interesting thing to ask about, because different firms have different investor committee decisions. Like some of them are unanimously, all the partners have to be on board with doing a deal, and then they sign off on it. Some of them are, you are the dictator, and this is my deal, I'm doing it, and I'm sticking my neck out on the line. Or some of them is like a majority vote, raise hand kind of thing. So that's actually kind of a fun question to ask as you're getting to know them as well. What's your decision-making process like? Like, what's investor committee? How does that work? They always meet on Mondays, and then they make decisions from there. So I will say that round of funding is one of the most informative things that ever happened to me, because Rob Meinhardt, our board member at the time, he was in that meeting, and we left, and I got the biggest pep talk of my entire life from Rob, basically like, fuck that guy, all this kind of stuff. And he just like, dude, it was a business changing meeting actually for me, between like how bad that was and then the pep talk from Rob afterwards. It was like a bad thing, but a great thing all at the same time. So then we ultimately got introduced to Gary Swart at Polaris. He loved what we were doing. He could see the opportunity and the vision and everything. And so they got on board, and we closed that round in January of 2016. We were just reminiscing with someone in the room about how close we were to zero cash at that date, and to bridge ourselves from the seed to the A round, I racked up, about 50 grand in credit card debt just to stretch us to that spot. So, but we made it happen. After that, everything changed wildly for me. The Series B, C, and D rounds were all very similar. We were not raising at the time. We were approached by investors. We had a few approach us, and I liked them overall, and they just aggressively came after us and put term sheets on the table. And I was more in this like run and gun mode of I would be on, I'm pitching them up front, and I'm hyper transparent about our numbers. I've tried to tone it down a little bit as we've gotten bigger, but like early on, man, I would just say like literally every metric. And I'm also confident that we're properly calculating our metrics and doing all this stuff. Yeah. So like I'm confident talking to it. And with that, you can get to a term sheet faster. So I would do my arm waving, talk about the product vision, the success, and then the business in some regards was just speaking for itself because we were doing really well. And so all of those were more, like I said, informal. I'm not raising. Okay, maybe we should do a fundraise. And then what I noticed is you say the amount that you want to raise, and you are generally going to get oversubscribed, and you can leverage that as a means for pushing price up as well. Because you can say, well, I'm not comfortable giving up more than X percentage of the business. And then the math becomes a little differently when you say, oh, you want to deploy 20 million of capital. I don't want to give up more than X percentage. You back into a valuation from there.
Genius.
And you kind of make it happen. So I felt like I could play more games and had more like levers to pull to make it happen.
Let's talk about that. You didn't always, like, price is obviously important, but you didn't always take the highest price, right?
No, and the Series D I did not take the highest price. That was, so the B round, which was led by Insight. I had never met Insight before, so they just like flew in, got to know us really quickly. They were really aware of us because they knew us through the Toba connection. Toba's connected with them, so they were pretty familiar with us. And Vinny at Toba had said really good things about us, so they knew how we were doing. But yeah, it was a crash course in getting to know them, and they got really excited about what we were doing. At the time, the challenging part with them was they had a reputation as a private equity shop, and so I really had to get like convinced that they were going more in the venture route and thinking more about not growth at all costs, but like growing and going public and that kind of thing. And I ultimately got there and really enjoyed getting to know them, and then they just blew other term sheets out of the water with price. So I felt good about kind of all angles of that one. So that was awesome. The Series C was a little more relationship driven. I knew, so Norwest led our Series C round. I had known Sean Jacobson from the Cornerstone days. So I was talking to him and saying, yeah, I'm going to run a process in the following Q1. Like I was saying I was going to run a process, and I was. So I was trying to do the more formal approach like what you did. And then Sean just cut it off at the pass and gave us a really great term sheet and a really good price that I thought would be probably what I would hope for in the next quarter anyway. And I like Sean, I wanted to work with him. So I figure from a relationship perspective, the quality of the fund, and then not burning our time going through this whole thing, like let's do the round right now. So he cut that one off at the pass, preemptively did it. And that was maybe one of the easier ones for me. And then the D round was, we weren't raising. The people started coming to us. And what was really cool about that round was a lot of these investors were learning about us from their portfolio companies. So a lot of their portfolio companies were using FloQast. And so, you talked like George at Meritech, who ended up leading our Series D round. He's just like, yeah, every one of our companies is using you guys. I hear about you all the time at board meetings. So I had to see what was up and why it's so great and everything. And so we had a ton of inbound interest. I ran a short, informal, quick process that was just really like all over the place. It was erratic and everything. And then people started putting term sheets on the table, and they moved from there. It wasn't like, the process we just ran, it was like, here's the term sheet, take it or leave it is kind of what it felt like. But with the Series D, it was just all so fast moving. Like the first one came in at, I think like around $1 billion, and ultimately it worked its way up to closer to 1.2 from there. And so some working along the way. But yeah, like you mentioned, it was still about the relationship and finding the right partner and the right fund, and specifically the right partner, as you mentioned earlier. And so George over at Meritech, he was by far my favorite throughout that process. And yeah, they didn't pay the most, but it was totally worth it to get him on board. They weren't like far off or anything. And, all I had to do was I just said, hey, George, here's the other one I have. Like, can we just split the difference or something? And he was like, sure, it sounds good. And so and I look back on that decision, and I'm very happy that we made that call, because George has been great to work with ever since then. So all that said, it's, me running around, arm waving, doing it all by myself, and then with the support from Greg, obviously, Greg, our controller, then providing all the financial diligence information, having to hop in, and just like, then I dump a lot of work on Greg's plate after the fact to go through all of that. And, I'll be on the follow-up calls, answering some of the diligence stuff. And then Eric, our general counsel, on the legal side, helping close everything, working with Gunderson to get all that work done. So in some ways very similar, but in some ways very different as well. And I can't tell which one I liked more. In some ways, I like the run and gun kind of style. In other ways, I love how you just teed me up. And it was the easiest process I've run. And it was like by far the simplest for me. And it was the highest price. We got great investors, and it worked out perfectly.
Yeah. It feels pretty good to have that done in a solution that we're all really happy with. And now we can go back to building great products for our customers.
Yep. So could not agree more. So we put that one to bed, and now we're off to the races. Yeah,
absolutely. You want to share the price with everybody? They might have already seen it.
You did all the hard work. You go for it.
All right. Well, we did end at 1.6 billion post, which is great. I think a lot of companies are saying flat is the new up in the current environment. So it was great to have an up round with great investors, where you can see the fruits of all the hard work for the company over the last couple of years, and and really how far we've come and how much, to me, just how much everybody believes we're still going to go.
Yeah. And something else to note, when you see headline valuations and press releases, and ours is going to say 1.6 and everything, but there's a lot more in a term sheet than just the valuation, right? There are all kinds of onerous clauses you can agree to or not agree to that kind of make that number a little more BS or a little less BS. And one of the things I'm really proud of is it's a vanilla term sheet, if you will. There's no onerous VC friendly clauses. Like the main one I look at is just participating preferred shares. I can't stand them. We don't need to dig into them right now, but if you want to go research something, participating preferred type shares is one that I don't feel is appropriate. And so that's one where investors can kind of have it both ways if they head in that direction. And so we kept all that stuff out and still kept the headline number of the valuation really high, which super proud of all of that, because what it does is it puts all the common shareholders, which are you, me, the employees, in a really good position to succeed and make money at the end of this whole thing.
Yeah, I think anytime you start adding in the weird clauses for the latest round, one that creates a lot of disconnect between the latest round investors and your prior investors, and it creates a huge disconnect between your common shareholders and your employees versus the latest round. So doing those might get you to a gaudy number that the number makes you feel good, but operationally and value-wise, you're actually giving away quite a bit. And so I wouldn't say never do it, but think very carefully before adding structure into your deals, because you're creating a situation devaluing a lot of your common stock, and you're going to run into issues when people figure that out.
I just want to give let's give a quick example. So liquidation preference is another one where you can really like finagle the headline number. So liquidation preference. Do you want to explain it, or you want me to?
Yeah. So generally, preferred shares have some protections if the company doesn't do as well as it plans, right? So generally, let's use round numbers. Let's say you raised at $1 billion, and you got $100 million in at that $1 billion. Company falls apart. It's no longer worth $1 billion. The $100 million gets their money out first, so before any of the common shares. And you start stacking those. You have Series A, B, C, D, E. And then the latest round normally has the highest preference. Now, what happens if that preference is not just the $100 million they put in and it's something else? And I think that's what you want to talk about a little bit.
Well, so in that example, you raised $100 million at $1 billion. Let's say something goes horribly wrong and you sell the company for $80 million. That $80 million is all going to the investors who have the preferred shares. None of it's going to employees, founders, common shareholders, anything like that. So what kills me is one of the things that I at least was told of in the last bear market. Fortunately, we haven't had to talk about any of this, but you can negotiate multiples on liquidation preferences, right? So it's like we get a 3x liquidation preference or a 4x liquidation preference. If you agree to something like that, we could have gone to the street and been like, sure, we're offering a 4x liquidation preference, and we probably could have raised it at $2 billion valuation or 2.4 or something to that effect. But to clear the valuation hurdle and the risk that would then put our early shareholders and our common stock at is just not what's in the best interest of really anybody around here except for that specific investor. And so that's where you got to stand firm on things like that. And it's more important to think about the structure of the round rather than just the headline number of the valuation. But fortunately, we got both, which is really exciting. So anyway, a little interesting kind of perspective into the terms of term sheets and how things can be moved around. And it's all negotiation at the end of the day, right?
Absolutely.
Mm-hmm. Cool. Well, yeah, the correct wrap up, I'm sorry I kept rambling after this, but the correct wrap up you had was we're really excited to put this behind us. We don't have to spend time on it anymore. We could get back to focusing on customers, product, and making everyone happy and successful. And that's a really exciting time in FloQast history.
Absolutely.
So Razzak, thank you so much.
No, thanks.
I really
thanks
appreciate
for having
it.
Me on. Thanks. It's a great milestone. I'm glad we could celebrate it on the Blood, Sweat, and Balance Sheet podcast. I can call it BS and BS.
BS. Yes. All right. Well, we'll wrap it up there. Thank you, everyone, for listening. We hope you enjoyed it, found it informative. And I'm going to mention one more time, if you want CPE credits for it, it's on FloAcademy. Go check it out. You can get there somewhere through FloQast.com. Check it out. Open to the public, obviously available for our customers as well. But I love it. Great service. So go check it out. Thank you, everybody. Appreciate it. Little behind the scenes here. So I had a lot of pride wrapped up in my background in accounting and finance and not needing a CFO for a really long time. And I just waited way too long before we made this hire. And it's something, as I reflect on FloQast, I definitely regret doing it. So I hope that over the course of this interview, you kind of get a sense of the value that a CFO can really provide above and beyond your basic accounting stuff that can get done, and kind of get that sense for ways you can utilize them other than bookkeeping and finance and stuff like that. So some of my favorite parts and things I would recommend you focus on for the rest of the session are really Razzak's ability to manage investors, how much work he was able to take off the CEO's plate, and really how much he thinks about making my life easier, quite frankly, as a CEO, which really makes him that much more helpful for us as an organization. So just wanted to really comment on like, hey, I wish I made this hire earlier, see a lot of the value that a CFO can provide to the CEO. And for those accountants who are watching this, I really encourage you to think about or pay attention to how he thinks, because he thinks a little differently than the accountant world. And if you follow more of his lead, that's a really great way to get to that CFO role and be the partner for the CEO to help drive the business forward. I hope you enjoy this conversation with Razzak, and have a great one.